Good morning. Thank you so much for joining us today on the show. If you look at it, the stock is up 55%. It's a stock that is available at a very competitive price as well. But we've started to see this turnaround story that is taking place and the thumbs up that is coming up from the stock market as well. Credit growth is back as well. Government wants a higher deposit growth. But having said that, and what the markets would want to know, the turnaround story, is that done? Going forward, is it about building on that momentum, building on the kind of credit growth you've been talking about as well?
Yeah, that's right. I mean, see, the turnaround story, I believe, is mostly done in the sense that we have actually cleaned up our balance sheet and we have adequately provided for our bad assets. Our provision coverage ratio at almost 92.8%, 93%, I think is one of the highest in the banking industry. The slippages are coming down. The slippages earlier were 1,500 crores per quarter. But if you look at it this year, June and September, they have come down to 500 crores per quarter. We are adequately capitalized. Our capital adequacy is at 14.02%. And if we add back the profit at the end of March, it would cross 15%. The growth has been good. The NIMs are improving. And we are opening about 200 new branches all over the country, having come out of PCA. So I believe that it will be the growth phase going ahead, and we have come out of that phase of consolidation.
So as you come out of this phase of consolidation and the turnaround story is completed, can I ask you, are you willing to change your guidance for the year? Are you upping your guidance for the second half of the year?
Second half of the year, I mean, I'm not upping my guidance for the simple reason that if you look at credit growth, we have also grown like the rest of the banking industry at almost 17%. But if you look at the deposit growth, it has been around 9.5 to 10%. So apparently going forward, of course, when it comes to deposit growth, it's a fact that if you look at the rate hike of 190 basis points in repo, banks have passed on to the extent of 75 to 90% as far as the deposit rates are concerned. So there will be a phase where I feel that the liquidity will be an issue going forward. Banks are slowly building up. So I think the credit growth would gradually moderate to around maybe 15%, 15 to 16% going forward.
Do you see that as a case specifically for UCO Bank, or do you see this as an industry phenomenon? Because banks do have the option of increasing deposit rates, and the minute you increase deposit rates, money can come back. I mean, you have to open the floodgate first.
Hey, that's right. But then see, I'm not just talking about my bank. I'm just talking about the banking industry. But what we have to realize is, see, for the deposit growth, especially on the retail side to happen, it is not that, you increase the deposit rate and the deposits would flow in at a rate to take care of this lag. Maybe in the interim phase, the banks have to depend a little more on bulk deposits, as well as maybe borrow in the TREPS window to take care of the liquidity issue, because the retail deposits, there would be a gradual growth. I mean, there will not be a flood of deposits to make up for this liquidity issue.
Now, Mr. Prasad, the sector is on a comeback. The animal spirits are back. But specifically for UCO Bank, the last decade was a tough decade.
Yes.
The whole experience of NPAs, moving back into PCA, you on a brink of almost collapse. I'm sorry to use that word, but you'll appreciate the spirit of my question. How will you come back and regain the mind share and the brand share? For a bank which was, let's say, out of business for a couple of years because of compulsions, a lot of damage could happen to the brand, to the CASA, to the fixed deposit. What are you doing to repair it?
See, if you look at the last 3 years, it is not just the UCO Bank, but I think most of the other banks have gone through this pain. Even a number of mid-sized banks were also under PCA. And all of us also know the reason as to why most of the banks have to go through this pain. because the credit growth that has happened during the time of boom and subsequently some of these large loans becoming NPAs because of various reasons, including legal reasons also. Well, that has added to the pain of the bank. So it is not something very unique to UCO Bank, but it is something which was common to the banking industry. So that is the first point I would like to make. The second point I would like to make is that after that, what has happened is the banks have realized, including UCO Bank, that I mean, you cannot depend on corporate loan growth for the purpose of growing your book, because even if one or two large corporate loans become NPA, I mean, the provisions to be made would be huge and there would be a hit on the profitability of the bank. So we have actually recalibrated our balance sheet in such a way that, I mean, if you look at it, the RAM sector, what we talk about, that is the retail, agriculture and MSME. For most of the banks now is around 60%, at least for UCO Bank, it is 60% and the corporate is 40%. So we have rebalanced our credit book. We have cleaned up the balance sheet. We have adequately provided for it. So I do agree that when you say that there was a phase when the emphasis or the focus was on recovery and consolidation and cleanup, and not so much on the growth. So that is what I'm talking about. But the brand as such, I mean, as you all know, I mean, since it's a government-owned bank, even in the worst of times, I mean, we have had our deposit growth, we had our loan growth when it comes to smaller loans. So I don't think the brand is hurt. But what I would like to say is that what has happened in the last couple of years is that we had to go slow on branch expansion because the bank was under PCA. So that is why I said that we have now realized that in this year we need to open more physical branches in areas, especially in cities where there has been a lot of growth. So, I mean, we are on a branch expansion mode and then we are in a growth phase. So I think going forward, things are looking up.
I'm so glad to hear that. Okay, now let's look at the good things. You know, as journalists, we always look at that fine print, that tough question, but let's look at good things. Good things are happening for UCO Bank. ROA, very impressive. 0.3 has become 0.6.
Yes.
If I say ROA of Union Bank in coming quarters could be 1%, am I being ambitious or is it realistic?
You're talking about UCO Bank?
Yes. I mean, your ROA, sir, has gone up from 0.3 to 0.6. Marked improvement. For me, that is a measure of how ultimately shareholders would like to see the growth. Exactly. Are you aiming to take it to 1% or will it be still a distance away?
No. See, what has happened is if you look at the first quarter, that is June, we had taken a huge mark-to-market hit. And the mark-to-market provisions were made at 7.45. So we have adequately provided as far as mark-to-market is concerned, for the simple reason that even today morning, I think the yields have opened around 7.24 or 7.25. So 7.45, I feel that with even the rate, whatever rate hikes are factored in, I feel that we have adequately provided for on the as far as the mark-to-market is concerned, and there may be some amount of write back going forward. So if you look at the September quarter is one quarter which has been one of the best for the UCO Bank, and where we made a substantial profit of about 505 crores. And going forward for this year, we have targeted a profit of 1,500 crores because last year we made a profit of 930 crores. So I feel that with this profit of 1,500 crores, I feel we'll be very close to around 1% ROA.
All right, 1,500 crore profit this year versus 900 crores last year. Good morning and thanks so much for taking time out. Now, you've focused heavily on global advances, which have grown nearly 70%. Talk to us about where you're seeing growth, which companies or which sectors is it that your lending is largely going to?
Yeah, first of all, as far as the growth on the corporate side is concerned, we have been extremely careful because of the experience that we had earlier. So we have been concentrating only on top-rated companies, A and above. So if you are asking me about the sectors where we are seeing the growth, we saw a lot of growth in the last 2 quarters in the area of NBFC, infrastructure, especially roads. Then we have seen growth in the areas of steel and cement, and also renewables. So these are the areas where we find that, there has been a good amount of growth.
Okay. I just want to understand as well from you is what kind of risk you're seeing in this lending, and on the domestic side as well. Are you seeing any risk to lending, maybe to say the MSME sector?
See, right now, actually, if you look at it, I mean, we do not see any increase in stress if you are talking about the increase in interest rates on account of the repo going up. So our SMAs actually are around 4% of the book, 4.2% of the book, and in fact, they have come down compared to what it was at this stage last year. But anyway, it is too early to say that there is no stress. But one good thing I can tell as far as my bank is concerned is that we do not have any large corporate account which is under stress. So yes, some amount of stress in SMEs. We'll have to watch the portfolio carefully going forward. But right now, if I look at it, I do not find any signs of concern as far as the stress either in the retail or in the SME segment is concerned, because these are two segments where the interest rate is linked to repo.
Okay, we're going to leave it at that. Thank you so much for joining us right here on the channel and being so candid. After coming out from the prompt corrective action framework, the turnaround story is here. It's real. 200 branches are being opened. Credit growth is keeping pace with the rest of the banking peers as well.